Hi, everyone. Thanks for joining. Welcome to the November Web Cargo Air Cargo Market Outlook. I'm Judah Levine, Head of Research at Freightos. I'm going to start this half hour or so off by taking us through the latest data for our air cargo market across a few key lanes. Okay, if we start with some of the major elements changing business as usual in the freight markets, more in ocean than air, but it's kind of important to keep an eye on even from an air perspective. So the first is the recent Donald Trump victory, which is most relevant to ocean logistics again and trade because his record of strongly leaning on tariffs for his trade policies and his announced intention during the campaign to increase tariffs across the board and on Chinese imports in particular during his second term. So in his first term, Trump had introduced tariffs of about 10% or as high as 25% on $380 billion worth of goods, again, with a focus on China. During the recent campaign, Trump had proposed a 10% universal tariff on all imports into the United States and a 60% tariff on all imports from China. So, in general, when tariffs are introduced, if there's enough time between the announcement and the actual implementation of the rollout date, a lot of importers will rush to move as much inventory as is feasible for them into the country before those increases go into effect. So this front loading increases demand mostly for ocean freight, but it alters the more typical timing of container flows because importers are starting to stockpile inventory. So that puts pressure on container rates during this rush and also results in kind of lower demand and less pressure on rates after for some time after tariffs will be rolled out. And this is pretty much what we saw in 2018 when tariffs were announced. So we had tariffs announced in July. They were meant to go into effect at their higher level at the beginning of 2019, and we saw ocean rates really increase in doubles in that period. Of course, this was a peak season, so it makes sense that rates will double, but we saw that kind of compared to 2019, we didn't see much of an effect on rates or much of a peak season increase due to this pull forward. And we saw something similar with volumes. Here we're looking at National Retail Federation volumes. We saw that year-on-year volumes increased every year for 9 years following the rebound from the financial crisis up until 2019. So we saw volumes increase a little bit more than the previous year in 2018, and then dip about 1% in 2019. And this was largely due to some of that pull forward. So volumes that would have gone in 2019 had already been shipped in 2018 to get ahead of those tariffs. So this time the anticipation of tariff increases may already be enough to cause this pull forward in demand, which would mean increasing ocean freight rates, and they're increasing from an already elevated starting point due to the Red Sea diversions. And this would also mean increasing volumes ahead of the anticipated tariff introductions, but also, again, likely less pressure on ocean rates and volumes for the period after tariffs take effect. The other kind of factor in, again, mostly in ocean freight in the United States, that is on importer and exporter minds is the still unresolved ILA Container Port Worker Union contract, which is still in dispute and still being negotiated with the USMX port operators, and this is for East Coast and Gulf ports in the United States. So the strike at East Coast and Gulf ports at the beginning of October lasted just 3 days. The strike did cause some temporary ocean to air shift and caused some backlogs and recovery that took a couple of weeks, but it wasn't terribly disruptive or extreme congestion or anything, and didn't have much of a prolonged effect on ocean rates. The strike ended when the sides agreed on wage increases, but they had deferred kind of coming to a resolution and a final contract to January 15th. So that date was set to resolve the outstanding issues, and the primary one is the role that automation is going to play at the ports, with the union strongly opposed to any automation, including semi-automation. The two sides actually started face-to-face negotiations this week for the first time, but they collapsed very quickly within a day or two, again, over the issue of automation. So this factor as well could be, leading to some pull forward and some apprehension about disruptions later at the beginning of the year, and therefore putting some increased pressure on ocean volumes and rates at this time. So this factor as well could be contributing to some of that front loading, and again maybe some shifting to the west coast. And in fact, if we look at updated National Retail Federation projections for November and December, they've increased those projections by about 350,000 TEU, 20-foot containers, compared to their projections just before in October, so before the election results. So that front loading might already be happening. In terms of air cargo, that we shouldn't expect too much of an ocean to air shift ahead of the tariffs, because there's really a lot of advanced warning, right? Once the President Trump needs to be first enter office, which is towards the end of January. Then there's a process for first, announcing tariffs and going through a review process before they're actually approved. And then usually once approved, there's kind of a future rollout date or sometimes a stage rollout date. So there probably is a good several months until tariffs, if they do happen, do go into effect. So we probably won't see an ocean to air shift, which is really reserved for much greater urgency. Although once the tariff date rollout date is set, we could see, as we get very close to that date, some last minute pressure on air cargo. In terms of the ILA strike, if it does happen in January, if there's no agreement by early January, we may start to see some ocean to air shift, and start to get some volumes as people rush to get some volumes received before the ports possibly close, which we did see a little bit ahead of the October 1st strike. And if there is a strike, we could likewise see some volumes shifted to air for crucial inventories during the strike and for a short period after the strike if there is significant congestion. Okay, so that's kind of more ocean issues that it could impact air. Turning to air, to the air cargo market, here we're looking at the latest IATA data for global volumes, and this is the latest data from September. And we see that monthly global volumes were more than 9% higher than last year, and that makes 14 straight months of annual growth. So Asia to North America volumes were 8% higher in September compared to last September, and Asia Europe volumes were 12% higher than last September. And this once again reflects the big role that B2C e-commerce shipments out of China to North America and Europe are continue to play in the air cargo market. And maybe it's even a little bit more impressive, given that already by this time of year last year, e-commerce volumes were already a significant factor in air cargo, and we're seeing year-on-year growth even now. If we look at capacity, we'll see this kind of sustained strong demand are keeping rates elevated, as we'll see in a minute, on these lanes that we talk about. And this is even as capacity continues to increase. So global capacity increased 6% year on year in September, which once again pushed capacity levels to another all-time high. If we look at what this has looked like in terms of freight rates, here we're looking at our Freightos terminal. For air cargo rates, this is our new light mode instead of our dark mode look and feel. I hope everyone enjoys it. So here we're looking at air cargo rates from China to North America in purple and to Europe in green. And we can see here that Trans-Pacific air cargo rates, so in purple, they climbed to about the $5 to $6 range starting around peak season of last year, and more or less have kind of stayed at that level through much of the year. So $5 or $6 per kilo from China to North America would typically be a pretty good peak season rate, and we're seeing this as kind of the base rate for much of this year. And again, this reflects that nonstop surge of B2C e-commerce volumes out of China that has been this really new and dominant factor on this lane for almost a year and a half. To start November, we did see rates increase about to $7 level. We've seen that on some weeks, although there's been some fluctuations. So we haven't seen like a very strong spike or a continuing climbing spike just yet, even though now we're kind of mid-November-ish. We're kind of in what's typically those peak season weeks already. And we've seen that prices have been even less volatile or less upward pressure in November from China to North Europe. Even if we look at it on its own, we see rates are still elevated, right, higher than they were before peak season of last year or second half of last year, but not as high as they had been in peak season last year even, although they've been kind of at this elevated level around $4 for most of the year. So as we said, we're still in early-ish November. In the United States, Thanksgiving is a little later than usual, so there's maybe a little bit more time till air cargo peak season will really kick into gear. But still, so far that anticipated peak season maybe chaos has not really materialized. Since we've seen e-commerce taking up so much, those volumes take up so much capacity, putting pressure on capacity and pressure on rates for a lot of the year, there have been expectations that once we get to peak season, we're going to see rates really spike and see it become very difficult to secure capacity. And at least so far, we're not seeing that materialize. And in fact, some forwarders, including a recent report by Kuhn and Nagel, think that it possibly won't materialize. And basically, the anticipation that this was going to be a very difficult peak season, that this was common knowledge in the market for quite some time that e-commerce volumes are taking up a lot of space, keeping rates high and keeping space tight. That was enough possibly to lead to some kind of pull forward to earlier in the year, possibly even by ocean or maybe by some air, that we're not going to see that same urgency during the peak season that we normally would, which again would push rates higher than they are currently starting, which are already at quite an elevated base rate. The other possibility is that a lot of forwarders had really turned towards BSAs or securing capacity in advance because of an anticipation of this of it being possibly a very difficult peak season, and therefore kind of more block space agreements and more capacity agreed upon and secured in advance is leaving less pressure on the spot market, and therefore possibly we won't see the kind of really volatile or chaotic peak season that a lot of people had anticipated due to this e-commerce factor. If we turn now to Middle East rates, to North America in blue, and to Europe in red. Middle East and North America, these rates mostly affect demand for sea air transport. We can see they're up to about $3.50 per kilo last week, which is 50% higher than they were back in September. In mid-September, and it's 30% higher than they were last year in this time of year at the start of peak season. But then they're about at the highs that we saw at the beginning of the Red Sea crisis at the beginning of this year. So this recent bump may reflect that some shippers are opting more for sea air instead of air, and that they're doing so early. And this might be kind of another adjustment that shippers or forwarders are making because of this anticipation of air cargo peak season being difficult, and therefore are kind of shifting more to ocean air, which needs a kind of a longer timeline, and now is starting to move through that mode. We see a similar story, though to a lesser degree, from the Mideast to Europe. We can look at this on its own. Rates are about 17% higher than they were for most of the first half of the year, up to about $2 per kilo, and also a little higher than the highs we saw during peak season last year. So this might also be an indication of some shift to sea air to service that peak season demand, again, as kind of an adjustment to anticipations of a difficult peak season. So finally, before we turn to Antonio, I probably said e-commerce volumes about 11 times so far, and these have been that big driver of volume strength and elevated air cargo rates this year, from China to North America and Europe. And as we've probably previously mentioned here, the unusual use of expensive air cargo to move inexpensive e-commerce goods is largely due to the savings that platforms like Temu and Shein can realize by using the de minimis exemption, which exempts goods in the United States at least of under $800. It's a lower threshold to most of Europe, exempts them from U.S. customs tariffs and the significant reporting or customs filing requirements and costs that come with standard imports. This surge in e-commerce imports is facing some challenges in both the U.S. and Europe from retailers who see this route as kind of providing an unfair pricing advantage to those platforms, and also from governments who also additionally argue that there's very low scrutiny and low requirements for reporting for these kinds of small imports, and that's being abused in terms of illegal goods entering the country or goods manufactured using forced or illegal labor practices, and it's just too hard to regulate. So there's a lot of different pushes in terms of tightening or closing this loophole. There's been in the United States, there've been a couple bills proposed in the House and in the Senate that haven't really gone anywhere. But the biggest challenge was this year had come from the White House, which announced its intent to issue a notice of rulemaking, and that would close that rule as delineated in kind of this announcement, would close the de minimis exemption to any goods from an extensive list of items that are subject to U.S. tariffs. And this list would encompass about 2/3 of all Chinese goods. And in terms of de minimis imports to the U.S., about 70% of them are coming from China at this point, and it's more than a billion packages this year so far. So if this executive order were issued, it could significantly increase costs for these types of imports through tariffs, but especially through the filing costs they would face, and also slow down delivery times to about 2 to 3 weeks instead of 1 week or 10 days, which would not be great for e-commerce delivery. There hasn't been any executive order issued yet. So the announcement was back in September. The executive order hasn't happened yet. Once there is an executive order, it can take like 2 to 4 months to be reviewed, if there address any challenges, and then go into effect. As it's getting later and later in the Biden administration, this is probably not going to happen, but it is entirely feasible that a Trump administration would be interested in something similar. So if this were to go into effect, it could significantly change the calculus of these platforms to using air cargo, and would send these type of goods, sending these type of goods directly cross border to consumers may not make any sense by air anymore. In the EU, we're seeing similar examples. So both Temu and Shein have been designated as very large online platforms, which means they are subject to greater scrutiny. The European Commission has just recently opened an investigation into Temu's possible failure to limit the sale of illegal goods. So we're seeing some challenges here as well. In the short term, there hasn't really been any impact on e-commerce volumes via air. As we've seen, rates have remained about where they've been the entire year, but there may be some signs that the platforms are taking these challenges seriously and getting ready for some kind of shift in strategy. Chinese exporters are building up inventories and fulfillment operations in Mexico, bringing goods over by ocean and then doing fulfillment from Mexico to the United States, which would still be subject to tariffs and customs if de minimis is closed. But we're just seeing the change in kind of how the supply chain is not, have these supply chains not relying completely on air cargo. And there was also a recent report in the Wall Street Journal that there is an increase in U.S. warehouse leasing by Chinese logistics companies, including for e-commerce, which likewise may signal that some platforms are preparing for a shift away from de minimis and therefore possibly from air cargo, and possibly towards building up volumes, building up inventories via ocean imports, and then building up fulfillment capabilities domestically on their own, which would look more and more like what Amazon does, for example. So it'll be something interesting to keep an eye on. And certainly, if there is a significant impact on the viability of using air cargo, that could have a significant impact on volumes, and therefore on demand for air cargo and on rates. So that's also something to keep an eye on. Thanks to all of you for joining as well, and we hope to see you next month.